Hello everyone and welcome to today's episode. We are going to unfold very interesting question on how BIS, Bank of International Settlements, has been created, by who, for what purpose, what it has to do with the current rising rate of inflation as per today's read, and also what it actually has to do with the debt crisis, since it's not only the US who is approaching $40 trillion in debt, but also many other countries, including the Western world and the Eastern world, not even touching up on all the countries in between. Let's get into it. Bank of International Settlements has been created in 1930 with the need and the idea, publicly speaking, in mind that after the World War I, there was a need to control and execute on the reparations paid to UK and France. Interestingly enough, BIS was essentially created by the leaders of central banks of the UK, France, Italy, Germany, Japan, and Belgium. One very peculiar detail here, that even though other countries have been represented by the central bank leaders, from the US side it was JPMorgan. Possibly because back in the days, US might have had a very isolationist policy, or also possibly because back in the days, JPMorgan, being essentially a private bank, effectively was a central bank in the United States. Also, interestingly enough, but JPMorgan has been supporting in a wartime UK and France. So when Germany has been paying the reparations, they were paying them to JPMorgan, while the BIS, largely created by JPMorgan at JPMorgan funds, have been gathering all the commissions, acting essentially more like some of the very first in a history investment bank. Later, the situation gets even more interesting. So you see, after the World War I, Germany, that has had to pay the reparations to allied countries, not only was effectively bankrupt, it also needed to pay the reparations, which means it was in a tremendous need of the capital. And you know where this capital came from? It has come from JPMorgan. Those loans were not free, and those reparations towards the UK and France were not free, and respectively the payouts from France and the UK were not free, and which has effectively created a loop in the payments from JPMorgan to Germany, from Germany to allied countries, from allied countries back to JPMorgan. Then, what was happening is JPMorgan and BIS effectively pulled from Germany all their investments, which of course Germany was incredibly dependent on. This caused effectively a crisis in German economy and overall in the entire Central Europe economy back in the days. At large, this has caused a level of national desperation in Germany to such an extent that Hitler has become a publicly rewarded figure. And in part, which is possibly just a speculation, but still quite logical, rise of Hitler Germany may have never been possible without US restricting post-World War I loans to Germany. Then we are seeing a beginning of the World War II, at which, and this is where it gets extremely interesting, effectively JPMorgan has been financing both sides of a situation. Germany, Belgium, France, you name it, creating the outflow of capital to Europe and then collecting it back plus fees via BIS, standing at the top of a financial pyramid, and the US dollar hegemony like no any other entity or country ever had. As of today, BIS is functioning as a bank of international settlements, as a central bank of central banks that is not managed by any elected officials. Central banks have relationships with the BIS, whereas the central banks also have relationships with the government, but not with the commercial banks, which also creates a very interesting multi-step diffusion in responsibilities for BIS being commercially profitable, and since it is effectively just a small area, highly governed in Switzerland, does not comply with any laws of any specific jurisdiction. And all this, given the situation that effectively BIS can even now refer with a policy that has to be mandated or at least very insistently introduced across the participating 62 countries. And mind you, it's not 195. As official line goes, not everyone is functioning and big economy enough to have a seat, or some countries may just not want to have a seat there. But let me tell you one thing: if there is a emerging markets country that effectively has US denominated debt, I would highly question the idea that they just don't want to have a seat at the table. But probably it is considered that they are not deserving enough to have a seat at the table. Regardless of this situation, BIS has a mandate to introduce a policy which effectively needs to be executed by the participating country members. And here we come to a Basel III. Effectively, what has happened is, after the 2008 crisis, when effectively a number of banks have become insolvent based on their previous actions, in 2010, Basel III was introduced as a framework that requires banks to have a certain level of liquidity. Effectively speaking, reserve requirements of how much of cash or cash similar assets bank has to have in principle in correlation to what do they lend. To give you a very essence of what Basel III is, it's essentially a requirement for the commercial banks to hold 8% reserve assets for every loans that they give. Think of it this way. For every $100 of liquidity that bank creates, they need to have somewhere in their own reserves $8. Would it be in cash deposits? Would it be in possibly T-bill notes, or something very similar to this? Which also can explain that effectively banks, commercial banks, do create liquidity, printing money out of thin air, effectively. And interestingly enough, that effectively Basel III was watered down dramatically by a number of states, such as US. It still largely received a huge pushback from JPM in particular. Later on, it was effectively even reduced in its scope to only 1,000 of the biggest banks in the United States. It was effectively very much watered down by the UK and many other countries. But what does it actually mean? Truth is, for a number of years, commercial banks were creating liquidity out of thin air. So it means that retail customers are coming to the bank with the idea to finance their purchase or their business. And bank creates monetary units out of thin air with the collateral of the loan that these monetary units are being created for. And that's the name of the game. Still, people are coming to the banks because of this residual belief that bank holds money, whereas bank creates money. Now, step number 2, as to who actually has potentially any influence and why. It was such an open question where it pertains to the liquidity guidelines that BIS has been trying to introduce with Basel III and Basel III Endgame. See, with the mandate from commercial banks to create liquidity pretty much out of thin air, it is very difficult to convince the banking system that they need to function differently. There are certain risks associated with this kind of activity, obviously, and that's why, for example, in a number of cases, we have central banks as a lender of lost reserve. So when the commercial banks are getting a little too much in a trouble, lending too much to the customers with a risk profile substantially lower than the risk models, then central banks would usually step in and bail out. In 2008, we actually had an examples of bail-in, so which means effectively that bank loans are being compensated using the deposits from a general public rather than the monetary emissions from the central banks. Of course, that creates a lot of tension in the society, a lot of possibly social unrest, which of course no government in any part of the world would like very much to have. That's why bailout sounds like a way more substantial and stable version. But now, let me give you a little bit more logical endeavors as to why BIS and commercial banks may have a little bit of a dispute here. Thing is, if BIS can impose certain frameworks, literally they would be telling to central banks, and they respectively would be executing it via commercial banks, how commercial banks need to lend money. And if you think of it from a certain perspective, all they do outside of personal relationships with the demographics is pretty much running the risk models, which effectively then reduces the indispensability, if you will, of the commercial banks to the system. By the way, together with the fact that not so many of retail customers have given it a thought that their rate of borrowing from the commercial bank effectively, in spite of risk model analysis, has very little to do with their actual risk model analysis, and has a lot more to do with the overall economical situation in the country or in the market, and the level of personal relationships with your banker. In the case, central banks cannot impose much of this sort of regulation on the commercial banks. Commercial banks have an incredible level of operational independence. But the moment certain security protocols, if you will, would be transparently implemented from BIS to central banks to commercial banks, this is where commercial banking becomes highly regulated with no choice and no flexibility, or at least much restricted flexibility from the banker's standpoint. Though they are very creative people, so I'm fairly confident they could always find something. Nonetheless, it is a substantial restriction in freedom, and now I would like to water it down the thought experiment of what does it actually mean for Joe and Jane, specifically referring to the fact that BIS is currently pushing central banks for CBDC experimentation that effectively will impact businesses, commercial banking, and everyday Joe and Jane. And now let's take a step back, that effectively BIS has been created at large at the push of JPMorgan with the idea to seize all the fruits from the dollar hegemony and the rest of the world compliance to it. It kind of makes sense why CBDCs per se are not exactly a popular idea in the US. Reason being that CBDCs as a management tool has little to do with the dollar itself. But using CBDCs in the rest of the markets and in a number of emerging markets, the use of so-called stable coins effectively supports the hegemony of the US dollar to a very high extent, which in return, when all this system of security protocols, commercial lending protocols, central banks operation, commercial banks operation, business operation, and the retail works by the same rules. And as well, we have a raise in productivity thanks to AI, and many companies are having layoffs or restricting the workforce based on the improved productivity thanks to AI. It really makes sense that CBDCs for retail customer can become a little time restrictive. But also another line of this thought experiment suggests that is it really just a different or a worse position of a retail customer than it has been in a number of years, where unless they own meaningful assets, and by this I mean productive assets, they had no control on money supply, interest rates, their borrowing costs, versus the CBDCs. They will have not a control, but at least some level of transparency, and they might have still a control over their time. And in any case, entire new Basel III endgame system still has very little of an objective for the national debts to ever be repaid, and that's why you may never see an agenda of any single country that is taking active steps or any meaningful consideration as to how to repay this debt, because the way out of 40 trillion in debt, you have only two options. Option number one is a default, where effectively state says that, sorry, but we cannot execute on our obligations. And it would actually make the global financial system fall, because at this point in time, everything is pegged to dollar. And as much as I find interesting some BRICS attempts to alternative systems, it is still very much not in a level of readiness to replace the Bretton Woods system. And especially in the case of emerging markets with a dollar denominated or outside of default, option number two is inflation, which means money printing, which means that everyone who does not own assets, or ideally productive assets, will be losing their purchasing power. And they would be losing their purchasing power in the US and pretty much in any country of the Bretton Woods system, and especially in emerging markets, you can land on a double digit. So to summarize all of this, my top line perspective on BIS and CBDC has been adjusted, since effectively it does not leave a retail customer in a much worse place, if anything, to the position they are currently are. It still makes a lot of sense to own productive assets as a key objective, regardless of a system you might find yourself in. This is the only way to measure wealth, regardless of inflation, regardless of what the government is doing, and regardless of all the nuances in the global economy that might arise. On this note, I would like to share that inflation rate we are currently seeing at 3.9%. Well, that was predictable. I would be a little surprised. We may also now start to see the rate hikes sometime in the second half of this year, but also it will be very interesting to see whether AI game would live up to its name and would actually be able to deliver, or just as a historical reference, a number of European banks have been raising rates right before the 2008 crisis. Which means that if history is a teacher, it is time to have a cash position. On this note, I hope you found this video interesting and educational, and I will see you the next time.